All right, welcome back. My name is Joe, again with Shaw & Sons, here with Sagar Shah, the CEO of Shaw & Sons, the CPA as well. And we are going to be going to something a little different. Last couple of videos have been geared towards individual decisions that we're making, and I think this decision is a little bit more important. And what we're going to be talking about is how we structure ourselves from a tax perspective. So if you are starting a business, or maybe you've started a business and now you're starting to ramp up the amount of money that you're actually making, you're making more money, you're making more revenue, how should it be structured from a tax perspective? Does it make sense for me to stay as a sole proprietorship, meaning it's just me? Or does it make sense for me to set up an LLC? When does it make sense to move to an S Corp or a C Corporation? So that's really what we're going to be talking about in this video. And I think, really from high level where we can start is if someone's, started a business and now maybe their business is taking over their regular job and they're coming into this business where they're going to take this over themselves. When would they start to look at establishing an LLC or an S Corp to start?
Yeah, all right. So first things first is none of these entities necessarily save you money in taxes, especially an LLC. Right. There's no tax savings of having an LLC, right? There's liability differences. Now, an S Corp or a C Corp, there could be like personal tax savings differences,
right? Just
based on the way you've kind of gone about structuring it in your personal scenario and how you're setting up your business. But setting up an LLC, no real tax benefit.
Got it.
Now that being said, this is easily the number one question people ask when they're starting a company. It's what should I do? How should I set this up? How should I form it? Should I be in Delaware? Should I be in Wyoming? Should I be in the state that I'm setting it up in? And generally speaking, I know this is not the greatest answer in the world, but it depends on your personal situation, right?
Okay.
So depending on the way you yourself have been structured and the way your business is growing, whether your wife or husband makes high income,
right,
whether you live in a certain state, a lot of these things factor in. So it would be disingenuous for me to be up here and say this is the way you should set it up for every entity, because it's just not the case.
So like, you hear, oh, well, I have a Delaware LLC, or I have an LLC in a different state.
Yeah.
Like, can you give us an example of, or a particular example maybe of a client of yours that like it would be better for you to set up in Delaware than it would be to set up in New Jersey?
Yeah, high risk, high lawsuit entity or business of that type. It's harder to bring owners of a business to court in Delaware compared to other states. Now, if you're doing business in a specific state, if you're doing, you set your business up in Delaware, right? And now you yourself are working out of New York. Okay, and now you're gonna go open up a second location in Georgia. You are registering your business in New York and Georgia as well,
right?
Regardless.
Yeah. You
have physical locations there, you have employees there, you have sales that are occurring there. There's these things called nexuses, and when these nexuses are crossed, you do have tax liabilities and registration liabilities in those individual states. So if you're a one-man shop, you're opening up an ice cream shop in New Jersey.
Yeah, you're not instead of a Delaware.
And now you're opening up a Wyoming-based shell corp. So it doesn't matter. You're still registering in New Jersey. You're still registering for payroll in New Jersey, sales tax in New Jersey. So at that point, a lot of times I end up talking to these clients like, well, now you're also wasting money by filing taxes in Wyoming. Right. So
in some instances it makes sense, but then there's some clients who just want to hear, oh, well, I should have a Delaware LLC. And it's like, well, the person you were talking to doesn't own an ice cream shop.
Exactly.
So their recommendation makes sense for their situation, not for yours.
Maybe they have an international corporation that's a C Corp that's trading in every market, and they sell something like a baby product, right? Where there's high likelihood of lawsuits.
Right.
In that case, yeah, sure, go set yourself up in Wyoming or Delaware. Well, once again, these are more legal questions that you should be talking to your legal person as well as your tax person to come up with what's the best setup. Now, that out of the way, where are the actual benefits and what should I be doing, right? That's still generally a question people have. So let's try to use examples of the various different criteria and the various different structures. So, generally speaking, there's a corporation, which is typically a C corporation. That can be one route that you go down. The other is going down the LLC route, or partnership, or a single member LLC. But there's two different, tangents.
Those are the biggest sides of the spectrum. LLC to C.
That's the starting point, right? Where are you going to pay the taxes personally for everything you earn, or is the C corporation going to pay the taxes, right? And it might be easy to say, oh, well, I want the corporation to pay all the taxes, but it may not be the best decision for you, right? So if you're somebody who's going to be relying on this money that's coming out of this business to run your personal expenses, and you want to be able to take money out whenever you need it to pay for your expenses, you're probably going to want to go, see LLC in that route. Right. Because there's no tax for distributions, free flowing capital between your personal and your business. There's some states that do charge a little bit for these distributions, capital distributions, but let's keep that aspect out of this.
It's another video.
Yeah, it's another video. So now C corporations, lower general tax rate since the new tax laws, and expected to stay low with the proposed tax laws. So you pay a flat 21% tax. But if you're somebody who's making less than, let's say, $200K a year, your personal income tax bracket is probably lower than 21%.
Right.
The effective rate after you take all your expenses and your deductions.
Yeah, you're getting less than 21, so they set up a C Corp, made it more difficult.
Made it more difficult for yourself. You can't take your money out if you need it. You have to pay dividend tax if you do issue a dividend to yourself, and your corporation is kind of holding all this cash. So generally speaking, the smaller businesses, something that's going to be a one-man shop, something where it's you and maybe a couple partners and you have some employees, in those cases, you're pretty much better off going with that you pay flow-through, pass-through route. So those are LLCs, those are LPs, pretty much anything other than a C corporation.
Limited partnership, sole proprietorship. All right, so those are the two sides of the spectrum, right? There's the limited liability side, sole proprietor side, and then there's the C Corp, right? Biggest difference between partnership, sole proprietor, and the LLC is the liability, right?
Correct.
So now let's dive into each one. So let's dive into LLC, then we'll upgrade to S Corp, then we'll upgrade to the C Corp, and then let's talk about what are the differences between them, why, what advantages does an LLC have, and then what is the next level advantage that an S Corp has.
Right, and that's the right way to look at it, right? It's almost as if as your business scales, you usually will see people switching from an LLC to an S Corp to a C Corp. And it's not always the case, right? There are big LLCs out there, and there's reasons behind that. But generally speaking, most people are not going to be doing that. So let's use the example of somebody who's a 1099 contractor. You got a job to do some tech work or some back office work or something, and they want you to go on contract as opposed to a W-2. Right?
Yeah, so like my wife's occupational therapist in the school, they contract her to work in the school. She doesn't work for the district. Yeah. So she's 1099 all of her business.
Right, right. So in her case where she's getting paid on a 1099, we have this threshold that we use for people. And it's depending on the state you're in, between $50,000 and $80,000 a year after all of your expenses, your net profit number. Okay. LLCs pay an extra tax beyond S Corps and C Corps. So on top of your income, you pay an additional 15% self-employment tax. That 15% self-employment tax sounds like something you would want to avoid, except there's costs to avoiding it. There's S Corp fees that you pay every year. There's payroll taxes that you pay, because S Corps mean you have to take a payroll, which we'll get into when we get to the S Corp conversation. There's also additional filing fees. You're filing a separate type of tax return versus something that goes inside your personal tax return as a single member. So there's these additional costs that come into play. Now you save that 15% tax burden, but we've gone through this exercise for years and years and years, and the number we've kind of come to agree upon is somewhere between 50 and 80,000, depending on the state that you're in. Net after all of your expenses.
And this is we as in like our firm, or just in general, like from an accounting?
I think most accountants use the same
spectrum.
But this is the number we use. Once that profitability hits past 50,000, that extra 15% tax you're paying is no longer offsetting the costs of the S Corp.
Gotcha.
So once you get past that number, if you're going to be making 150,000 a year on your contract and you don't have many expenses, you're not driving around, you're not really traveling, you're maybe writing off 5-10 grand a year out of that 150, it's almost always going to make sense to go S Corp, because that 15% tax on that 100 grand, $15,000, it's going to be way cheaper. You're going to save at least $15,000 if you pay for the payroll, pay for the S-corp fees, the additional bookkeeping, all these other things. You know, maybe depending on the accountant, could cost you somewhere between $5,000 and $7,000 a year.
Right.
So at that point, you're already saving $10,000 in taxes
just from that.
Just by switching to an S-corp.
So let's stay on LLC.
Yeah.
Things like the structured liability is a main reason why people would move.
Yeah. Yes, correct. Like if you have a rental property and you have somebody that goes in there and slips and falls, having that LLC, there's a liability protection which constrains a lot of the value of that asset and the liability of that property within that LLC.
So someone's doing freelance internet work and they're making websites, right? There's not really much liability there other than you doing something fraudulent.
Yeah.
So really getting into an LLC would have other underlying factors other than the legal one. But let's say I have a car that I registered to my business. That's where you'd want to be involved with an LLC more than doing it as a sole proper individual, because now the car hits someone or you get in an accident or something happens and now they're not coming after you as an individual, they're coming after the LLC, which is what owns the car, right? So that's one main factor of deciding, do I even
100%.
need an LLC or not?
100%.
Right?
Single member LLC or a partnership LLC,
Right.
It's really a legal structure, not a tax saving structure.
Got it. Okay. So, and then, what would, like, examples of, like, what would an LLC be best for? Like, what type of groups, like, companies-wise? So, like, freelancers is someone that we talked about, right?
Yeah, small retail business. You open up a corner store. You're a real estate broker, and you are, doing this part-time.
Right.
Any small business that's not your main gig, but is a side gig, that's also something to consider. And, I don't want to get too far into the weeds on this stuff, but that self-employment tax we're talking about with LLCs only applies if you make less than $178,000 a year.
Gross.
Of taxable income.
Okay.
So once you go past, so let's say you have a W-2 main job where you're making $200,000 a year, and you go open a side business that's going to make another $80,000 a year.
Yeah.
That side business that makes $80,000 a year, you only pay income tax on it. You don't pay the self-employment tax.
It's not including the W-2.
It's not including the W-2.
Okay, so this business has to make over 178, as of 2025.
No, so the business, in order for you personally cannot make over the $178,000 number. If the business is making 50, but your W-2 is making 200, you're already over that 178 number by virtue of your W-2.
Right.
So whatever your business makes, you're already optimized in terms of the self-employment taxes. So you should not go to an S-corp if you have a full-time job on W-2 making more than that $178,000 number, which is, I think, an important thing to keep in mind. The LLCs, generally speaking, small businesses, side businesses, especially if you have a full-time job and it's something that you're doing on the side, you want to go LLC.
So now we breach 80,000 net expenses, everything else. Now we're converting to an S corporation. So
generally,
so let's say in this general situation, it is recommended that we're moving to an S corporation. What in your mind makes that recommendation? Why would somebody be doing it?
One, being in the right state and city.
Okay.
There's certain cities that have additional S corp taxes, like Chicago, New York City. They both have additional S corp tax. It's something you need to factor in your decision making if it makes sense to do it.
Yeah, you do the math.
Exactly, do the math on it. Now, let's assume you're not in one of those cities. Then, really, it's that bottom line income number being crossed. Two, the very important factor here is how much is your fair value for what you're contributing to the business? Because one thing with the S corp that the LLC doesn't require is you have to pay yourself on salary. Okay, so in an S corporation, there's no ifs, ands, or buts about it. You have to pay yourself a fair and reasonable salary, which is a very gray term, but it's still something you have to adhere to.
Right.
So that means that, let's say Joe is a personal trainer and Joe starts his own small LLC that's doing personal training for a couple clients.
Right.
And he's making, a little bit of cash on the side. And he's doing fine, he's paying taxes on it. Then over time, he decides he wants to be a full-time professional trainer. You're making, let's say, $100,000 a year from this business, okay? In this case, what we would, we say, all right, well, you're paying this extra $15,000, that 15% self-employment tax that we can get rid of if Joe goes on to S corp. Well, he also has to run payroll for himself.
Right.
So what we would do is we'd go on a website like Glassdoor, for example, and look up and see what is the average salary in your area for a personal trainer.
Right.
And
you
let's
couldn't
say,
pay yourself 10 grand and the average personal trainer makes 50.
Exactly.
Okay.
Right. Now let's say we look it up and it says 50,000 is the average salary for what you're doing. Right. And let's say we run through it and we, for argument's sake, 50,000 makes sense in this case that you can pay yourself. That would mean that 50,000 that you're paying on W-2, there are payroll taxes associated with it. There's costs associated with it, but the cost of those payroll taxes are going to come out to around $6,000 or $7,000 probably.
Okay.
If you're running that full 50,000 plus your payroll processing, all this is somewhere around.
And you say 6 or 7, meaning like from an accounting's cost?
No, from like a payroll tax perspective that the business pays
off
and
of
you
100.
pay.
Is there a percentage? So it'd be 6% compared to the 15 that you would pay for self-employment.
Because you're paying half the salary.
Okay, got it.
So now the other 50,000 you're taking out for yourself as a distribution, which you just pay regular income taxes on. So in this case, you saved yourself about $7 grand by just simply changing your structure and putting yourself on payroll.
I see. So no matter what, whatever you don't pay yourself in salary still gets paid to you, but you don't have to pay the payroll tax. You don't have to pay self-employment tax on it also.
Correct.
So let's use an example, right? So let's say I'm the personal trainer and I'm saying, okay, does it make sense to move to an S Corp? First thing that we need to think about is, do we have a predictable amount of income that I know every year I can pay myself a salary in, right? If I have 4 or 5 people that just come every once in a while compared to 40 clients that have been with me for 2 or 3 years, I know that income is going to be there.
Yeah.
That's probably a point where I know that I can continue to pay myself that salary because the clients are predictable.
Yeah, I mean, that's the best. Now, obviously, if people leave
it
and
can
your business
fluctuate.
goes down, you don't have to run yourself into a loss running payroll for yourself.
Okay, so you can always adjust it.
You can adjust it, yeah. If income goes down, it's like, hey, I can't afford. Same way any normal business would say, I can't afford to pay. I need people to take pay cuts.
Right. So let's say you make $60,000 a year, but you make furniture and you refurbish furniture and you sell it, and then there's 3 months where you make 10 grand, and then there's 3 months where you make 0. Right? How you structure it from a payroll standpoint would matter as far as the variability of how your income comes in, no?
Correct.
Or could you just run a payroll at the end of the year all at once?
You do that too. You have flexibility and you have to work with your accountant on what makes the most sense.
Yeah,
right?
so the accountant's really going to be the one to coach you through those decisions.
Definitely. I mean, generally speaking, the easiest solution is, hey, you're just going to take every 2 weeks a paycheck.
Right.
But if your business is a seasonal business, then we need to sit and say, all right, we're going to take a lower payment now. We're going to take big bonuses at the end of the year
or quarterly or
whatever the busy season is that you have.
Got it.
So there's strategy that goes into that. Ultimately, though, if there's one thing to take away from this is, if you decide to go with the smaller pass-through route, if you cross that certain threshold, if your fair salary is lower, you might want to lean towards that S corporation. Now, here's an example where it doesn't work. So you're a doctor, you're a cardiologist, and your business is making $350,000 a year. If you look in our area, average cardiologist salary is probably close to that. So you're now going to pay yourself almost everything you take as an individual, as a W-2, and you're going to pay all those payroll taxes again anyway. Right. So it could be, to your detriment in certain scenarios, or it could be not very beneficial in some scenarios. So that's why it's important to talk to somebody who knows all these things so that they can give you every criteria and make a decision that's informed. Now, the other option, the third option.
The C Corp.
The C Corp.
So now, how does a C Corporation differ from the tax structure of not having that flow through tax liability like you would in the other instances?
Yeah, so generally speaking, C Corporation, the more money you make, the more beneficial it is for you. You're making millions and millions of dollars a year in your business, you may want to consider becoming a C Corp, right? And the reason behind that is C Corps pay a flat tax of 21%. You're making $6 million a year, right? Just throwing out a random number. $6 million a year as a C Corp is going to be way less. It's going to be 21%. So what is that? It's like $2 million of taxes.
Right.
Versus if you run it through, let's say you live in California and you make $6 million a year, you're going to be paying close to 50%. And if you're in certain cities, you may be paying even higher than that. So right there, you're talking about a $1.5 to $2 million tax savings on being a C corp versus an S corp, right?
So
Or an
S corp,
LLC.
let's use the 6 million as an example, right? You're getting paid 6 million. You're an S corp. All that 6 million flows through to you, whether you're paying yourself in payroll or you're
Correct.
taking the rest of it.
Correct.
So the rest of it would be over that 21% because 6 million, you're probably 37% at that point.
Yeah.
In a C corp, are you taking a payroll for yourself also?
You should, yeah. So you would count as an expense for the C corp, so it doesn't pay the tax at that 21%.
Right.
Let's say you're some fortunate guy who's making $6 million a year, right?
Yeah.
Once this applies to a very small segment of the world. So,
Right.
but let's say you're one of these people, you only need $1 million or $2 million to survive,
Right.
and you're saying
Survive.
everything above that, everything above that is just excess at that point.
Right.
So you tell yourself, all right, I'm going to run a $2 million payroll, and I'm going to pay the taxes on that personally. I'm going to
Payroll
spend
tax,
all the money.
all that on
I'm
there.
going to pay the income taxes on it. I'm
Right.
going to cut myself a W-2. I'm going to live my life however I like. And then everything above that, instead of paying 37% federally
21.
and paying another 10% to the state, I'm going to pay just the 21% federally, and I'm going to pay whatever the state's corporate tax rate is from the state level.
What changes that? What could change that? I mean, obviously legislation.
Oh yeah, so slated to expire if the BBB doesn't pass, go back to 35% for the corporate tax rate.
So that's going to change a lot of people's tax structure if it doesn't go through.
Yeah, I mean, we advised a lot of people to go into C corps for the last few years.
Yeah.
People that make more money than they need, that are in businesses that they also want to give out shares to employees. They have foreign investors. All these things factor into a C corp. So it's not just about the tax savings. There's other things that go into it.
So let's go into some of the other stuff. So from a tax perspective, obviously anything up and above what you're paying yourself out in a payroll. And now is there like that Glassdoor type of dollar amount that you need to pay yourself through a C corp also?
Yeah, you should still be paying.
You still be paying a
something
reasonable
for
income. Okay, so we're paying ourselves a reasonable income. Now we're having that. What other benefits are there from having a C corp compared to an S corp? You mentioned foreign investors.
Yeah, multiple share classes, right?
So like you're offering preferred stock. Just
non-voting shares, your voting shares. You're gonna raise a round.
Right.
That's a different share class. That you have those options. If you're bringing in venture capital money,
Right.
So you have a project that you started. It's a tech company,
Right.
and you want to scale it up. Then it's not an ice cream shop. In this case, you're looking for outside investors. They're typically institutional investors.
Right.
In this case, you're going to want a C corporation because that's what the investors are going to want. They don't want pass-through taxation. They don't want to have to deal with the headaches of getting the K-1 from you.
Right.
They want to park their money, get their shares, and when they exit, they exit.
And you want a different type of share class, so you don't give them voting rights in some instances.
Depends.
So that you can, unless they want it,
Yeah.
it would depend. So my personal training business would have to be massive.
It would have to
I mean,
be
need a C corporation.
institutional investors at that point. You got to be making to me, I think, and this isn't set in stone, but to me, I think you got to be making at least $2.5 million a year.
2.5. I think I can make that.
Before the C corp, just it makes a ton of sense at
Right.
that point. I think under that there are situations where it could make sense.
Yeah.
But that's like really where for an individual standpoint for tax savings. But there's a lot of reasons to have a C corp not for tax savings, right? One of them is raising money, getting institutional investors. Number 3 is a sale. If you sell your
Sell the
C
business.
corporation, you actually get a huge discount on the capital gain. If you started the business with less than $10 million, when you sell, your first $10 million of profit could be tax-free. And that's another big reason to go C corp route. So giving out shares, giving out stock options to your employees. These are things you can't normally do in an LLC or an S corp. They can only be done in a C corp. So there are many reasons outside of just tax savings, but there's a nice little tax savings aspect to it as well. It's great for people who are building a company where they plan to continue to reinvest and they don't want to take out the profits for themselves or spend the money.
Right.
Which many businesses do. Businesses like you and I do that, right? We're generally earning for ourselves. But if your plan is, I want to continue to take everything I'm earning, reinvest it back into my business in the most tax efficient way possible, C corporation is probably your answer. Another important thing, which we kind of talked about this, is pass-through versus C corp. This is another major difference. So there is this lower tax rate. So assuming you're outside of that top 37%, there's a lot of reasons where you want to be an S corp or a C corp. S Corp or an LLC.
Right.
But there's another little caveat that exists that allows you to take an additional little piece off. It's called QBID. So depending on your industry and depending on what kind of products you sell, whether it's your services or an actual physical product, you may be able to take advantage of a QBID tax break, which is 20% that you take off of the top from the K1 that passes through to you.
So that's the extra up and above your payroll.
That's the extra above and above.
So QBID is qualified business income deduction, right? So we're now making $100,000 as a personal trainer. I've decided $50,000 I pay to myself as a reasonable income, and then the other 50 has the ability for this 20% additional deduction.
Correct.
Before it hits me, just a general income tax.
So that's another 10 grand that you slice right off of your taxable income.
So how do you know when you're in that?
So it depends on the type of
category.
Income is a great portion of it. If you make under a certain amount of money, you automatically qualify.
Okay.
The next portion to that qualify you is if you're selling actual products versus your time and services. That's like a general rule of thumb. So you and I don't qualify for QBID, but if you were a pharmacist or if you were the ice cream guy, those people are selling actual physical products. So those people would get this 20% additional QBID deduction. So that, you're in a 20% tax bracket, you're now in a 16% tax bracket. So it's a nice additional 4% to 10% depending on your tax bracket that you can take on top of that. If you like, why don't we run through one real world example that we kind of cooked up?
Yeah.
Right. So we have one that we threw together just to kind of bring all these things together and make decisions as to when and how a company may make these decisions on changing. And keep in mind, a lot of these structures you have the ability to change, as you go along and as your business changes. So, let's say we have this company, Blue Horizon Consulting. It's in North Carolina. They need to make a decision. LLC, C Corp, S Corp, what are we going to decide here? So first years, initial phase when this company is starting up, you're making about 50, 60K a year is what they're projecting. In this case, we're going to probably want to lead them towards the LLC. Small business starting up, don't know if you're going to be around forever.
Right.
Don't want to invest a bunch of money into building these really complicated structure and infrastructure. So a simple LLC partnership between the two partners that we listed before, and not only are you going to get that, you're going to take that 60K, you don't have to run payroll for yourself, you're going to pick it up, you're going to get 20% comes right off the top with the QBI, and then everything on top of that, we have that 15% cost plus additional expenses, but almost no cost to maintain the thing. You're basically going to be running this thing per year for less than $1,000 a year. Cheapest, leanest way to set your company up off the ground. As this company is moving along, they start making a little more money. They get, they're projecting now year 3, they're going to be making about 140K. We go through, we see each spouse reasonable salary in North Carolina is $40,000 for each one. That's considered in the average ballpark. Right? So that means that's 40 and 40, 80,000 minus the 140 that they're expecting. We're looking at about 60K that's left that they're going to draw out as a dividend. When we run through all these things, and we'll throw this up on the screen so you guys can see it, we're basically going to have, after we run the payroll taxes, after we take the QBID, not factoring payroll costs and service costs, let's just assume it's like $2,000-ish. The total tax savings comes out to about $12,000 in savings going to S Corp versus LLC in this case. Once again, we'll throw
think
this
about
up.
what you could do with $1,000 a month by changing the tax code.
There you go. Exactly. And so you're not really doing much. You're running payroll for yourself. You saved yourself $1,000 a month in taxes. That's just extra money in your pocket just by a little bit of a thought exercise. Now let's say after this, they're looking to grow and they're looking to add more people. This is where you really have to do the calculations on the S Corp versus C Corp, and you have to be really realistic with yourself as to what you want your business to be. Everybody wants to have a giant Fortune 500 firm. It's the reality of the situation is it worth it to invest into this goal if it's not attainable and reasonable? Because you could be setting yourself back pretty significantly from a tax perspective. Generally speaking, when you swap to this, make some of these changes to the C Corp, you end up paying a little more tax initially just based on the way that you're drawing your income out for yourself. However, if the income grows, if you get past that $2 million number, if you don't need every dollar your business is making, now all of a sudden you're saving yourself lots and lots of money. For this one, we'll go ahead and throw this up. We'll also put up a copy of this case study if people want to look into it a little further. And if you want to reach out to us for questions or consultations on any of the things we've discussed, look us up.
Yeah, thanks for joining us, and look forward to seeing you on the next one. Thanks.